number of important points you mentioned there. John, I'm coming to you with a key question here regarding cash. So, Lyn and I talked a lot about both the CapEx underinvestment in a lot of key commodity producing sectors that, irrespective of all the other issues going on right now, we talked about Rick Rule, who said before the inflation problem and before the war in Ukraine, that if we just sort of kept things at status quo, we'd be entering critical shortages in certain key commodities in the next 5 years or so, just because of decisions that were made 5, 10, 15 years ago in terms of starving a lot of these sectors of CapEx, right? Then, of course, that gets exacerbated by the shortages that we're having right now, created by the war and other supply chain issues. So as Mike just said, that's going to provide a tailwind on these commodities, these tangible assets going forward. We then also have all of the currency devaluation concerns on top of that, with all the central bank balance sheet expansion, all the fiscal stimulus that's been done, et cetera. So it's kind of this double whammy against the purchasing power of, paper, basically. And so as Mike is saying, hey, we want to look to real things. I know that's a big part of your investment focus, guys. But it gets complicated, right? Because you would say, all right, well, then get out of everything paper and get immediately into hard assets. But we have this issue that Mike was talking about, where the central bank has many fewer options now than it did, say, back during the Volcker era. And so we're now going into this period of economic deceleration that Lyn mentioned. And the Fed is actively out there raising the cost of capital right now, trying to bring down demand, et cetera. So, we very well may be going into a recession here, and that may bring down the prices of almost everything, including eventually, if the Fed is successful, demand for commodities, at least in the near term, the next couple of quarters, maybe next year plus. So where I'm going with this is, we can look at those big macro trends and say, well, that's really bullish for tangible assets, but we got to be cognizant of what that's over the long term. But in the short term, and by short term, I mean next 6 months, next year or so, the forces may be really disinflationary / maybe even eventually deflationary. And that's where cash comes in, right? Because if you're looking at that long-term arc, like I mentioned, well, you probably want to sell cash, immediately and just buy hard assets. But, you could lose a lot of value along the way if we have this, massive deceleration, massive pull down of asset prices, et cetera. And so where I'm going with this is you really have to be cognizant of what's going on and nimble, and you may need to play strategies like cash in the short term to then be able to redeploy it when the time is right into these harder assets. And I know that's the role you guys play as financial analysts here. But I wanted to kind of raise this because this is something you guys have to think about all the time. Correct, John?
Absolutely, Adam. And there is quite a bit of nuance there. From a classic textbook standpoint, cash is cash, and long-term bonds are some of the very worst places to be in a textbook inflation environment. But that's over a long period of time. If we're thinking about, the purchasing power degradation of cash over a 15, 20, 30-year period, certainly could be shorter than that, 5 or 10 years. But point being is there are absolutely many examples in history where even with inflation, cash can be one of the very best places to be in the short term. Look at this year to date, for example. Most assets, aside from energy and some of the real goods that we talked about, are down pretty soundly on the year. Broadly, stocks are down. Broadly, bonds are down. Some areas of the stock market are down way more than others. Yet cash, and this is in a very headline grabbing inflationary environment, and cash is, on a relative basis, preserve purchasing power over this short period of time much better than most other assets. And if we go, for example, to the 1970s, which is similar in some ways to right now, with stocks being overvalued and inflation being a problematic thing that the central bank hasn't been able to get under control yet. And I found it interesting that Lyn pointed out that Volcker didn't just come in with this novel idea of taming inflation. His predecessors, two predecessors before him, had that same agenda, and they just couldn't get it under control. So point being, if you look at the 1970s, stocks got hammered in the early 70s because they were at very, very rich valuations going into an inflationary environment. And look at today's news. Target, for example, the retailer Target, just twice in the last, or three times, two times in the last 3 weeks, they've lowered earnings guidance and have said they have to raise prices due to inflation, and it's getting hammered, right? So that's just one example of so when inflation starts to take hold, rich valuations in stocks, broadly speaking, are some of the very first things to go. And broadly speaking, stocks, when they're at reasonable valuations, can be a very good long-term inflation hedge. But the key is they've got to be at valuations that are not obscenely overvalued like they are right now. So the cash, in a very long-winded way, represents a really important ballast in a portfolio, we think, right now, that can be converted to other things when they are priced more favorably to become that better inflation hedge than stocks, for example, today broadly are able to be right now.
Yeah, all right, good, thanks. Yeah, I asked this because I still see some headlines out there that say, in inflation, cash is trash, et cetera. But you just gave a great, explanation for why it can be really important, especially key elements in the timeline of a stagflationary collapse or correction. Lyn herself started off the interview talking about, sort of a barbell type of allocation with sort of energy stocks on one end and then a lot of cash in U.S. Treasuries on the others. And even your example there about Target, John, yes, high prices, high input prices is forcing them to raise their prices, which hurts, the consumers coming in the door there. But also they said that they had excess inventory. And I think that's part of, it's part of the bullwhip effect, where you just have a lot of inefficiencies when you're reacting to shortages. And we've talked about that in the past. But I also think that Powell's efforts are beginning to bite. You're beginning to see the beginning of demand destruction here. I think it's going to get a lot bigger, and time will tell. But we should expect more of this. And if that indeed happens, and this is becoming a pattern, right? We saw Amazon, Walmart, and now Target basically say, we overstaffed, we overstocked. That's kind of the classic signs you see sort of heading into a recession, because that's showing that consumer demand isn't showing up the way that these companies were planning on. All right, Mike, we'll come back to you here. So Lyn, I think, did a pretty good job of sort of explaining, okay, here's what I think we should be doing given the macro conditions that we're heading into. She talked about diversification, which I'm glad she did, because I don't think we can mention that enough here. Very important part of just a good portfolio construction in any environment, but particularly in one like the one we're heading into here. We're having to place bets based upon how we best see things going on here, but not every bet's going to turn out right. So the diversification is hopefully going to really be your friend here. But she talked about owning good quality equities, those with good balance sheets, ideally good income streams, some real estate, some cash, and hard assets. And we talked about the fact that she's a big fan of a lot of commodity producers, but energy in particular. She likes not only the companies that are going out there and producing the commodity itself, but a lot of the infrastructure-based companies as well. One thing to note about oil itself, which I know Lyn is quite bullish on, is after interviewing her, Goldman just came out with a forecast saying that they see oil hitting $140 a barrel by this coming summer. Oil's at about 119, 120 right now. $140 a barrel. I mean, that's getting close to the all-time high of like $149 a barrel. And that was pretty hellacious when we hit that back, when was that? Like 12 years ago or so, 11 years ago. So to be back up there that summer is definitely not going to be pleasant. So anyways, Mike, curious to hear your reaction to Lyn's allocations. I think a lot of the spirit of it sounds similar to what you guys are doing at New Harbor, but what do you think?
Absolutely. A lot of the spirit is there for what we're doing. I mean, we wouldn't expect anyone's opinion to match exactly what we're doing, because obviously nobody knows for sure what the future brings. But Energy, she talks a lot about, and we like it too. I mean, I guess I would comment that energy seems to be getting a little bit extended. If you look at the ETF XLE, it's up around 91, technically extended. Now, that doesn't mean it can't go higher, particularly if crude does hit 140 by the summer. But we really do like that sector long term. We would have hedges in place. In fact, we do have an energy position with hedges in place. But we would be looking for opportunities to either buy more or add, or buy it back if we end up selling it on dips in the market. She also talked about, she also talked about other things like resilience. She talked about paying down debt, simplifying your life, reducing expenses, even having some basic things like food, medicine, and other things like that. And she said not to be a doomsday prepper, which I don't think she is, or any of us here are, but it certainly makes some sense to go into the cabinet and see if you check on your old stores of those types of things, or if you don't have them, to at least have a little bit, just in case shortages do arise. It's possible. Starting to notice some empty holes on the grocery shelves. It does seem like shortages are going to be more of a commonplace thing going forward. So just some basic preparation makes sense. In terms of investment strategy, I'm not sure she talked too much about gold and silver. I might have missed a little bit of that, but gold and silver are certainly at a very viable place here. I think we mentioned last week that gold's action has been almost boring recently at 1850 or 1860, but still on a weekly and monthly chart, the bullish breakout out of the triangle a few months back is still valid. It's almost a sleepy kind of sideways move. We would expect that to resolve, probably resolve upwards. So think about adding to or establishing a gold and silver position. Other than that, we agree having cash makes sense for what should be an ultimate or eventual opportunity as this market dips. On the S&P, which is down only about 13% year to date and 14% from its all-time high, it bounced sharply off that 3,800, 3,850 level. Really think the next move down is probably to the 35, 3,600 level if we take out this kind of recent support around the 4,000 level, which seems like a cement floor. But when that changes, I think we see a fast move down there, and that could be another short-term opportunity. But those are just some of the things that we're looking at right now.